DSCR loans are the most powerful financing tool for real estate investors, but no one understands how to really use them. While most investors are stuck chasing conventional loans, DSCR loans let you scale without income docs, W-2s, or even perfect credit. If you don't understand DSCR loans, you're missing out on the easiest way to grow a real estate portfolio in today's market. I'm Andrew Russell, owner and founder of RCG Mortgage, 4-time winner of Broker of the Year, top originator across the country, and I specialize in working with investors to put them in the right mortgage products and achieve real estate riches. I recently worked with a client. His name is Chris, and Chris didn't use me when he bought his primary home. He's a self-employed business owner. He used the actual bank that he banks with, depository institution. Yes, he said they put him through hell, but nonetheless, he closed and he owned the primary home. So Chris, he wanted to buy an investment property. So he reached out to the local bank again. And for whatever reason, he's self-employed, the way he wrote off his income, whatever his paperwork looked like, which I guess wasn't all that good at the time, they declined him for a pre-approval for an investment purchase. So it just turned out he's going to the wrong place. So he saw a couple of properties on Zillow. He reached out to listing agents. One of them we've worked with, meaning Andrew Russell. They referred him to me. And I was able to work with him and structure the right mortgage for his investment purchase. Now, based on him being self-employed and a business owner, there was really no reason on the investment purchase side because his income was so convoluted and he wrote off all his expenses. I don't think he qualified at that moment for his primary house on paper, let alone investment properties. We put him in the right mortgage, which was a DSCR mortgage. So now, as an investor, he was going to base the qualification not on his income documentation. We were going to base it on the market rent. And as long as the market rent basically covered the mortgage, he qualified, which it did. So we actually turned from a big fat no on the pre-approval side into he bought 3 investment properties with us within 6 months. And as we speak right now, he's actually out there looking for more deals. And of course, the questions always come in, but Andrew, of course, whether it's this guy Chris or Bill or Steve or whomever, the rates are probably so much higher, right? If you're not showing your income, you're gonna get a bad deal. No, that's not the case. We've alluded to in all of our videos back right before the pandemic and then the pandemic when these DSCR loans came off the shelf and when they came back, it's all about the margin, meaning if the 30-year fixed right now is at 6%, what is the margin? What are these DSCR mortgages at? Now, I've seen it as high as 2 to 4% higher, which means they can go up to 10%. Yes, it's a super high interest rate. But based on the performance, I guess people are getting DSCR loans are paying them on time. And based on the appetite, meaning more and more investors are opting for these mortgages instead of conventional mortgages or portfolio mortgages, the margin, meaning whatever the going 30-year fixed rate is versus what a DSCR loan or mortgage gets, could be between 0 and 1.5%. So I've seen 2 teachers buying a primary home, putting 30% down, get the same interest rate on a 30-year fixed as a seasoned investor putting down 25% on investment purchase. So depending on the market, depending on the time of the century, sure, the rate could have been a lot higher. But right now in this market, the rates are actually really good for these programs. And of course, hey, Andrew, I'm sure they have to show all of their paperwork for these. You say that you don't, but I'm sure you do. Pay stubs, W-2s, tax returns, multiple months, if not years of bank statements. What's your blood type? Favorite color? No. So it's true. Nothing about this is fictitious, or I'm not being malicious and trying to sell you a bag of something that doesn't exist. Literally, it's no income check. If you're an investor and you're purchasing an investment property, we're not looking at pay stubs, not looking at W-2s, don't need P&Ls, don't need even more than a month bank statements. Now, the lenders we work with are accepting 1 month of bank statements, sometimes even a week activity in your bank statements. So it's a no income check and it's all on the market rent. So as an investor, do your diligence when you're buying a property. What is the market rent? If you're buying $1 million property, is it a multifamily? Is it a 2-family? Can you get $3,000 a unit? Something like that? These are things you should know, because if you're buying as an investment and you're not moving in, you want to make sure that the rent covers the mortgage. But no documents required. It's a super streamlined and expedient mortgage only because it eliminates so many layers of documentation and it just makes it that much easier. And of course, Andrew, they're probably only offered for seasoned investors. The story about Chris probably didn't really happen, or you're not telling us something. What's the fine print? So no, not only do these loans allow for new investors, it used to be if you're a new investor, you might have to put more money down or have a little bit higher of a credit score or a couple of different factors. Now, you not only could be a first-time investor, you could be a first-time buyer. Now, of course, as I always say, there's 2 types of big fraud out there from an occupancy fraud perspective. You say you're moving in and you don't. You say you're not moving in and you do. Don't do it. It's actually a very, very bad thing. It's a huge, black stain in the mortgage industry. So It's being based off of the fact that you're not moving in, but you can be a first-time buyer and buy with a DSCR loan. And obviously you're not moving in, but they allow that with no history of owning properties. Now they may want to see that you pay rent, because if you're living rent-free in your parents' basement, living the dream, maybe you can't kind of manage owning a house and mortgage and being a landlord. But as long as you can show at least a history of like paying rent, which is very fair, you can be a first-time buyer, let alone a first-time investor, and get a DSCR loan. But of course, hey, Andrew, I don't have a property picked out. What's the point of watching this video? So pre-approval is very important to know what you're pre-approved for when you go out and look. Because it's kind of like the opposite, right? When you get a car. So the experience is you go in, you want to test drive the Lambo, right? Super cool. You saw some newspaper clipping, if you still get newspaper like I do. And it's like, oh, this Lambo is so cheap. It's $12.99 a month. And you're like, I don't know, what's the catch? So you go in there and you test drive it and you love it, right? And you're like, cool. And then all of a sudden it's like you always get introduced to the finance guy and that magical $12.99 turns into $39.99. And you're like, where did it all go wrong? You know, it happens all the time with cars. It starts at like a $6.99 a month for a Lexus. And the next thing you know, the finance guy does this thing and you're so much higher and you truly don't understand. Now, the same thing goes for getting pre-approved. When you're pre-approved, you don't want to go and see the house. It's like driving the Lambo. You're going to fall in love with it. But what if you don't qualify? You're wasting your time, your family's time. If you're an investor, your partner's time, if you have one, the realtor's time, whose time is very valuable, naturally. So you want to do the pre-approval first. It's almost like going to the finance guy first, seeing what you could afford, seeing what you qualify for from a car lease perspective, then test driving it and falling in love. So it always makes sense to do the pre-approval now. Do your diligence now, just so when you go out to shop, and shop around for a house, that you shop with confidence and it's not wasting your time or your emotion. All right, so all things DSCR mortgage. We're going to look at right now the GOAT of investment, mortgage purchases, and refis. What does it take to qualify? We're going to look at the credit side, the asset side, what it takes to qualify from a market rent perspective. Do you even need to show the market rent? Can you even just buy these straight up with no market rent? You can. So we're going to go over all ways you qualify for DSCR loans. Before we do, make sure you go in the description, click the link, guys, and download our free guide to DSCR loans, the GOAT of all investment mortgages, without a doubt. No, I'm not talking about Tom Brady and his run at quarterback as a Jet fan. No, what I'm talking about is a DSCR loan, the GOAT of all investment mortgages. Hop in the description, click the link, and download our guide. All right, so DSCR loans, let's get into it. All right, all things DSCR. Let's go over what it takes to qualify. What does the credit, income, and asset side have to look like? Because remember, income, we're not showing actual income and documentation. We're going off the market rent. So what does it look like on an amazing whiteboard here? And I'll give you a real-life example and talk through all the different options, what it would take to qualify, so you can be empowered to become a DSCR mortgage user and investor. All right, so if we think all things DSCR, the GOAT of mortgage. All right, with that said, when you think DSCR, the example that I've always consistently used, let's use $1 million sale price. Let's do a 20% down payment, so it's an $800K loan. Let's use loosely a rate of 7%, 7.5% APR, about $5,600 a month. This is very loose for principal and interest, but it's pretty accurate. Let's say another $1,400 a month for taxes and insurance. So you got a $7,000 a month mortgage payment. So with that said, let's say this is a 2-unit property. So what does a 2-unit mean? So a 1 unit is just one livable unit. So you have sometimes 2 units, sometimes 3 or 4. Sometimes the DSCR loans even allow 5+, which they started to do. Sometimes even 10+ units. You think of like the bigger buildings, or you think of an actual property where you walk in and there's all the different units within it. So as the months and years have gone on, the program specifications has expanded. So I'm just using a basic 2-unit example for a DSCR. Is it used all that many times on a 1 unit? It depends on the area. Some investors buy a lot of 1-unit homes on the same block or in a specific area, but more often than not, we see DSCR loans on multi-unit, 2-unit, 4-unit properties. They are allowed on condos, and I've seen it done on 1 co-op, although it was very difficult, but typically it's on multi-unit properties. So just remember from a market rent, because when we talk about credit, income, and assets, this is all what we always look at for pre-approvals. On the credit side, when it first started, when these loans first came out and lenders were a little bit more conservative, they looked for a 700 score, maybe a little bit higher. If you're a first-time investor, maybe a 740. As these loans have, you say the word performed. What does performed mean? Just means that the mortgage payments are being paid on time and timely. So that's good for the servicing companies, good for end investors, and then that flows back downstream to the client. So what's happened is I've seen credit scores as of late as low as 620. There are rumors that the number 5 is allowed on these. I wouldn't necessarily talk to you on YouTube and say, if you have a 500 score, the DSCR loan's right for you. You probably should work on your credit first, because when you get as an example, an $800,000 mortgage, if you can't pay your current bills on time, or you're struggling there, your score is not where it should be, you're paying things late, you probably shouldn't get almost $1 million mortgage. Just my opinion. But with that said, I've seen credit scores on the credit income and asset side go down to as low as a 620. Now we'll skip to assets. So assets, typically they wanted 2 or 3 months. They wanted to make sure it's all your own. So it started with 2 to 3 months of bank statements. They want to make sure it's all your own money, seasoned, large deposits make sense. That was when they first came out, several years ago, and it was more conservative. It kind of flipped now. Lenders are okay with 1 month of assets and large deposits. They're fine with them. Oftentimes they don't even ask about them, and it allows for the G, gifts. So the big thing with investment mortgages on the Fannie and Freddie side, on the conventional mortgage and even portfolio side when you go to a credit union, that they weren't allowing for gifts. So if you wanted to buy a 2-unit property for $1 million, putting 20% down, first and foremost, it would have been 25% down. That's the guideline for investment. This is a little higher of a financing point, which is cool, but I digress. They wouldn't have allowed, Aunt Bessie to offer monies as a gift to purchase, has to be your own money. Why? I'm sure someone somewhere with more degrees than me had a good reason for it, but regardless, they didn't allow for gifts. So now, just remember again, credit income and assets. That's what it always takes to qualify for this stuff, right? So it went from 2 to 3 months bank statements now to a month, which is super cool. Large deposits, whatever it is, wherever it comes from, it's being asked, like, what is that? Less and less. And gifts. So if Aunt Bessie wants to invest in your investment portfolio, you can. So the asset side has definitely become more aggressive as of late. And last is the income, which we'll go over here. So there is no income, right? There's no pay stubs, right? It's kind of like a goof that I wrote that there. No income, so no pay stubs, no W-2s. We don't ask about your job history. This is the income piece right here. It's the market rent. So we're going to go over, in this scenario, what it would take to qualify, what the rate kind of margin would look like. Is there going to be a prepayment penalty? What the heck is a prepayment penalty? Sounds exotic. Like, do I want those? Sounds scary. We're going to go over all that stuff right now as it relates to the third piece, the income side. So on a 2-unit property, this property, I remember, each unit netted $3,500 in rent. Now, this is market rent. Sometimes the current tenants aren't paying the market rent, and these loans will allow you to go off the market rent. Even the tenants are a little bit less. There might be some caveats there. They may want the current tenants to vacate at time of close, or that'll be read into the contract. But market rent is typically the income piece that we use for these specific types of mortgages. So what we look at is the ratio of market rent to the actual mortgage. So there's something like a 1-to-1. There's a 1.25-to-1. There's a 0.75 to under a 1-to-1, which we'll go over. And then there's a NR. No ratio, right? So depending on where the rent or lack thereof falls, the interest rate, right? Here you go, your 7% rate. That is what is directly correlated to these answers as it relates to the income side. So a 1-to-1, I don't have to tell you guys, you don't have to specialize in math. $7,000 in market rent, $7,000 mortgage payment, that's a 1-to-1. The market rent on a 1-to-1 basis covers the actual mortgage payment. Now, a 1.25-to-1 would mean, now if rent was $8,750 or more versus the $7,000, right? So what did that look like? Let's say, instead of this, we're at $4,500. So that would be a little over $8,750, so about $9,000. So if rent was high in these units, and you added together that $9,000, it's over 1.25-to-1, meaning the rent is a lot higher, to keep it simple, right? And if that's the case, if the going rate, it's, this is 7% right here, this might be 6.5 or 6.75. You get a rate discount for having better rent versus the market, versus the mortgage payment. So these are two things to look out for. Again, when you think of these properties, and we were talking about the pre-approval side before and the importance of it, unfortunately, you could be pre-approved for a DSCR mortgage, but the property itself has to be pre-approved as well. So you have to inquire like, hey, Mr. and Mrs. Realtor, what is the market rent on this property? And then you say, hey, Mr. Russell, not that you're calling me Mr. Russell, sounds kind of cool actually, and I may roll with that, but I digress again. What is the actual mortgage payment if we use a basic market rate of say 7%? This is what the agent said the market rent is going to be. So where do we fall? Is it the 1-to-1 bucket, which is the typical average price of these programs, say 7%? Is the market rent crushing the mortgage payment, 1.25 or more, which is like $8,750, $9,000 versus $7,000, which just means the market rent's really high, which means you're going to get a better than market rate. Or the next piece, 0.75 to 1. So for instance, if we said the market rent was $5,600 to the $7,000, market rent is less. Hey Andrew, why in God's name would you buy a property where the market rent is less than the mortgage payment? What are you, crazy? Like, what is like a weird hobby? No, because maybe if you buy this $1 million property and it's a 2-unit, maybe the zoning allows for a 4-unit. So instead of, $5,600, this would be $2,800 a month for each unit. That's $5,600. Maybe if you cut those large 2 units in half and turn this property legally for this price point into a 4-unit property, maybe that $1 million valuation turns into 1.6. So you're gaining that just in equity. And you're not going to get as much rent. Let's just say that $2,800 turns into $2,000, which is less, but now you have that times 4. So that's $8,000. So then all of a sudden, the rent is more than that $7,000. So there's always a scenario where maybe this third option over here makes sense, but it has to make sense for you. But again, typically they've wanted a 1-to-1 ratio, the 1.25 to 1. Obviously, no one's not going to lend you money in the DSCR space when the rent exceeds the mortgage payment, but they now opened up the third bucket, which is if the rent is close, the $5,600 to $7,000 as an example is close, but doesn't cut it. But there has to be a reason. Like, we're not going to ask you the reason. I would just, say as Mr. and Mrs. Client, why, between us, why would you, there's got to be something that we're missing. And as an example, hey, Andrew, we have contractors in our family. We're going to turn this $1 million 2-family into a 4-unit property. The value is going to go up. And instead of $2,800 times 2, it's $2,000 times 4, which increases our cash flow a lot, right? A little over 50%. This is why we're buying it. This is the vision. Cool. And if that doesn't do the trick enough for you guys, the no ratio program is killer. Now, what's some of the negatives? Instead of say 20% down, no ratio is we don't even ask for the market rent. We don't even put it on the application. We don't ask the appraiser for it either. So you're like, wow, that sounds so simple. Why doesn't everyone just do that? Because it's just one less thing and variable. Because the down payment might have to be higher. Instead of 20% down, it might be 25 or 30 or 35%, depending on the specific lender that you work with, your credit score, your experience. So the down payment will go up. And of course, the rate. Yes, folks, although the DSCR rates aren't all that much higher, when you do the no ratio program, the last one I saw, that 7% went to 9.25. So if you get a 7% rate versus a 9.25 and you do a finance for a Lexus, which is a great car, it's not going to ruin your day per se. But on almost $1 million loan, if you go from 7% on a 30-year fix to 9.25, that's a huge difference. So the big factor for DSCR loans, as we went over, the credit side, it's improving, 620 score or above. It's a lot easier than a 700 score or higher. The asset side, super streamlined. It's the income side. The whole deal is over here. How many units? What's the market rent? Is rent exceeding, which is option 2, way exceeding the mortgage? Great pricing. Is rent the same? Good pricing. Is rent a little under, but I'm sure you have a method to your madness? Decent. This would probably be 7.5 as an interest rate, as an example. The option of it's between 0.75 and 1 of the 1-to-1 perspective. So like 5,600 versus 7,000. The rate will be a little bit higher, but do you want to have nothing shown? No rent versus your mortgage payment, put a little bit more money down. Easiest loan to do in the world, right? It's just run your credit. You have the money to close, done. Simple, right? Well, what's the catch? 9%, 9.25 rate. That's kind of the going right now. And the closing costs are a little bit higher. So make sure when you do your diligence on these, on the pre-approval side, not only are you pre-approved, you have to pre-approve the property. So if you're still thinking, why haven't I heard about these loans? They sound so amazing. You're actually not alone. Make sure you watch our next video, DSCR mortgages and why 99% of investors don't use them. We're gonna go into the whole mortgage type. How did the market not know about them? So make sure you watch our next video.